Hey everyone, welcome to This Explainer. Look, if you're in your 20s, 30s, or 40s and you're actively building your financial future, you have likely been conditioned to absolutely dread an economic downturn. I mean, every headline and every financial pundit on TV basically trains us to feel like a falling market is a total catastrophe, right? But what if the actual data tells a completely different story? Let's hit the whiteboard and map this out.
Okay, front and center on the board today is a harsh, undeniable truth. The stock market will crash. It's not a maybe, and it's definitely not an if. It is a when. And when it does happen, it's going to wipe out trillions in paper wealth. Millions of people are going to panic, they'll sell, and they will permanently lock in their losses. Honestly, they'll be reacting exactly the way human beings are biologically wired to react to red graphs and financial chaos. But here's the real question. While the vast majority is running for the exits, what exactly is the minority doing?
Well, while everyone else is in full-blown panic mode, a small group of financially intelligent investors is actually quietly celebrating. They don't panic, they don't sell. Instead, they use this exact moment of maximum fear to quietly buy up literally everything they can afford. Because the greatest wealth transfer in history, it doesn't happen during those stable, rising bull markets. It happens during crashes. The crash essentially does all the heavy lifting for them.
Which brings us to the core thesis of today's explainer, drawn straight from Tony Robbins' powerful book, Unshakeable. The central argument is really simple, but it's a massive paradigm shift. Basically, everything you feel about market crashes is wrong. A market crash is not a disaster, it's a massive generational sale. The absolute boldest claim here is that market crashes aren't these huge risks you need to avoid, they are incredible opportunities you absolutely must be prepared for.
So, moving right along to Section 1, 100 years of data and the undeniable pattern of recovery.
Now, we aren't just talking about some blind optimism here. We are looking at a full century of cold, hard data. Think about the Great Depression in 1929, Black Monday in '87, the financial crisis in 2008, the pandemic crash of 2020. What do all of these have in common? Well, every single market crash in recorded history has eventually been followed by a recovery that completely exceeds the previous high. Every single one. I mean, the 2008 crash? Fully recovered by 2013. The 2020 crash? It rebounded in just 5 months. Seeing this data shouldn't make you complacent, though. It should give you this calm, almost predatory mindset. It should make you ready to act precisely when everyone else is just too scared to think straight.
All right, Section 2, your brain versus markets. Let's dive into the psychology of wealth.
Robbins argues that the difference between an investor who builds true generational wealth and one who merely survives, it isn't about having a genius-level IQ. And it's definitely not about perfectly timing your trades. It is almost entirely about psychology. It's your ability to override your very own biological survival instincts. To really expose how totally irrational market panic is, just imagine this. You're walking past your absolute favorite clothing store, and there's a giant sign in the window that says, "Everything 50% off." What do? You get super excited, you run in, and you probably buy 3 sweaters you don't even need. But now, imagine the stock market drops by 50%. The math is exactly the same. But the story we tell ourselves instantly triggers our deep survival instincts. In a store, a sale means a great opportunity. But in the market, we've been conditioned to believe a sale means terrible danger. To be truly unshakable, you have to actively choose that first story.
So how exactly do we rewire our brains to act logically instead of emotionally? Let's move to Section 3, 4 rules to become unshakable. This is the core framework.
Let's tackle the first 2 rules right off the bat. First up, corrections. A correction is defined as a 10% drop. And honestly, it's just normal weather. Historically, these happen about once a year. So if you've been investing for 10 years, you've probably seen 10 of them. It's not a catastrophe, it's literally just rain. Rule number 2, nobody can time the market. Seriously, you have to stop trying. The data on this is incredibly humbling. Get this, if you miss just the 10 best days in the stock market over a 20-year period, that is just 10 days out of 7,000, your overall returns are cut in half. And the people who missed those days, they were usually the ones who moved all their money to cash during a panic, waiting around for that perfect right moment to get back in. You just can't time it.
Now, I want to zero in on Principle 3 for a second. This is the asymmetry of loss, and mathematically, it is probably the most crucial concept to wrap your head around. Look, if your portfolio drops by 50%, you don't just need a 50% gain to get back to where you started. You need a massive 100% gain just to break even. Let that sink in. A 50% loss demands a 100% gain just to recover. Because of this asymmetry, your primary job as an investor is survival. Avoiding a catastrophic loss is way more important to your long-term wealth than trying to catch every single upward swing. You basically just need to survive long enough for compounding to do its magic.
Which naturally brings us to the fourth rule, asset allocation. Now this means building a portfolio spread across uncorrelated assets, stuff like stocks, bonds, and real estate, that is specifically calibrated to your personal time horizon. Honestly, asset allocation is your only real protection. It won't prevent all losses, obviously, but it is the true shield that stops those catastrophic concentrated losses we were just talking about. It protects your ability to survive and recover over the long haul, simply because no single asset goes up or down forever.
Moving on to Section 4, your crash preparation checklist. Let's draw up the architecture of wealth.
If you are in that 20 to 50 demographic, this right here is the exact blueprint you need to build before the next crash hits. Because just knowing the psychology isn't enough. You need the actual architecture in place. Step 1, build a financial moat. That means saving 3 to 6 months of living expenses in pure, untouched cash. Why? Because the person who panics during a crash is almost always the person who desperately needs the money to pay bills. Having a cash moat gives you the absolute psychological freedom to hold tight or even buy aggressively while everyone else is forced into panic selling. Step 2, know your asset allocation in advance and explicitly define what triggers you to rebalance. Step 3, automate your investments. Use dollar-cost averaging so you're blindly buying more shares at lower prices when the market tanks. And step 4, turn off the financial noise. The 24/7 news cycle is literally designed to keep you afraid and engaged. During a crash, do yourself a favor and limit checking your accounts to maybe once a month.
The absolute most crucial point to remember is this. The plan is written when you are calm, but it's executed when you are not. Now, I know there's a very real critique out there that buying the dip is a total privilege. Critics will argue that staying calm and buying during an economic collapse is only possible for people who actually have plenty of capital, while everyday folks are just trying to survive job cuts. And you know what? That is a perfectly legitimate tension. But this explainer addresses that head-on by showing that building these automated, pre-planned structures, specifically that cash moat we just covered, is the exact thing that removes the panic from the equation. Building that moat first is what gives you the stability to make crash buying a reality for you, rather than just some nice theory.
And we're going to wrap up with this incredible quote. The crash does not create winners and losers. It reveals them. Guys, the next market crash is coming. And when it arrives, the wealth gap is going to widen tremendously. Not because of an income gap, but because of a preparation gap. So ask yourself, are you going to be the person who panics and ultimately funds the wealth of others? Or are you going to build your financial moat today, write your plan while you're still calm, and quietly act when the time comes? The choice is entirely yours. Thanks so much for joining me on the whiteboard for this explainer.